Welcome to the AIA Global Market Highlights for October 2025. Today, we will review the latest market performance and key economic indicators that are shaping the investment landscape. Let's begin with how the global markets are performing. Markets came under pressure following renewed tension between the U.S. and China over tariff, technology, and rare earth. On October 9, China expanded export controls on rare earth elements, prompting President Donald Trump to threaten a 100% tariff on China's imports. Within 2 days, over 1.5 trillion in market value was wiped out. This dispute has created doubts about the upcoming APEC summit on October 31st between Trump and Xi Jinping, with both sides escalating port fees and trade restrictions. This reflects deepening mistrust and a move towards economic decoupling, leaving global supply chains and investors in uncertainty. Yet, markets still remain surprisingly strong. Despite the tension, indexes are still at record high. As shown on my screen, the MSCI World Index is up 18.6% year to date, S&P 500 up 15.7%, and MSCI Asia Japan gained 31%. Strong company earnings, healthy balance sheet, and optimism around AI have helped global markets to stay resilient despite geopolitical uncertainty. Turning to bonds, we can see bond market is in green as well, potentially benefiting from the start of the rate cut cycle. Additionally, Fed Chair Jerome Powell actually signaled an end to quantitative tightening. Speaking at last week's National Association for Business Economic meeting, NABE, he reaffirmed a stable economic outlook, but noted signs of a cooling labor market. Inflation remains slightly above target, but broader pressures are easing. Powell also hinted that the Fed might stop its U.S. 6.6 trillion balance sheet reduction, signaling a more accommodative stand alongside recent rate cuts. Moving on to the key US macro data, we don't really have many new macro data simply because of the ongoing government shutdown. The current shutdown is now the third longest shutdown in US history, with no agreement in sight between both Republican and Democratic Party, and economic costs are rising as federal employees miss their first full paycheck. The delay in critical reports like the jobs data has left investors and policymakers without any key insights. The ISM PMI index for September 2025 came in at 50, down from 52 in August and below the 51.8 forecast. This shows the services sector is losing momentum, driven by weaker business activity and new orders. While supplier delays and price pressures rose, employment continued to contract, though at a slower pace. Some upcoming data to watch is the US CPI on October 24th, FOMC rate decision on October 28 and 29, and the PCE expenditure on October 31st. So, how is AIA positioning its portfolios right now? In global equities, we maintain a moderate overweight position. US equities remain supported by Fed easing cycle, solid technology fundamentals, and reasonable positioning. Further improvement in the market breadth and broader participation will be the key before we strengthen conviction in an overweight stance. The Fed easing cycle is back to the forefront, providing a positive catalyst for risk assets with downside supports as there remains little evidence that the tariff-induced inflation has seeped into the economy. US equity sentiments have recovered from 2nd April Liberation Day low, yet positioning remains light. Institutional investors' allocations relative to global equities is catch up to retail, but still light historically. Moving closer to home, Asia Japan equities, we maintain a neutral position. Fundamentals remain mixed, with lackluster earnings in Asia Japan versus developed markets. The region is undergoing a technical price consolidation that reflects a weaker outlook. That said, technology fundamentals, especially the semiconductors, continue to support spending in AI infrastructure, providing a strong structuring tailwind for beneficiaries, including Taiwan and South Korea. In China, sentiment is improving on the back of the policy support. While near-term fundamentals remain challenged, like your housing weakness and your soft consumer demand, we are still watching for signs of stabilization over the next 12 to 18 months, especially the upcoming new FIRE plan, which we can wait for it. With the policy implementation, this should potentially drive earning growth in China. Hence, we see a constructive longer view for China. In short, while fundamentals are uneven, selective opportunities exist, especially in the technology sector and China. Hence, we stay neutral overall in Asia ex Japan. Moving to fixed income, we maintain an underweight position, as strong US data supports a soft landing narrative, reducing the likelihood of a large rate cuts and limiting yield downside, making core rates less appealing. By underweighting, this does not mean that we does not like fixed income. We still hold them in our portfolio, but at a smaller percentage. And when we hold it, we would prefer investment grade bonds as they have a lesser default risk. So we are selective in fixed income while balancing yield and risk. In cash, we maintain neutral position as we are inclined to gradually redeploy cash towards risky assets as market sentiments improve. There are a lot of noises and volatility out there in the markets today. Tariff, inflation, policy shift, and geopolitical events. So this is where AIA Stewardship can add value to your investment journey. Through Stewardship, we don't just manage portfolios. We partner with institutional grade managers who have decades of track records and deep research capabilities. Their disciplined investment approach helps to navigate market volatility and stay focused on the long term. Together with our AIA in-house expertise, we build optimized portfolios, spreading investments across asset classes for diversification. AIA also actively monitor portfolios to keep you on track and help you stay invested through full market cycles, reducing your emotional decision and biasness. So as you can see, this is a continuous end-to-end stewardship process that helps you to stay invested, stay diversified, and stay focused on your long-term goals. Thank you for taking the time to join us today. We appreciate your attention and hope that you found the information valuable. We look forward to seeing you again soon. Thank you.